Now, the business cycle, remember I said, well, the business cycle is bottoming and not peaking. I know there's a lot of noise about recession, recession, recession. A lot of that was priced in back in 2022 from the forward-looking indicators. What we've got is the cyclical elements of the economy, car sales and stuff that are slow, miners and stuff that are driven by the business cycle. The business cycle is still chopping. Now, people say, yeah, but look, it rolled down. Yes, it did roll down. It happens at every low of every cycle. You tend to have this correction, and that's where we are now. So you can see the last 2 decades worth, you get this secondary dip before you get the recovery. So that's where I think we are now. It's kind of noise because most of the markets I concentrate on, crypto and technology, are priced off liquidity conditions and financial conditions.
So that's what Raoul Pal thinks about the current market situation. But if you don't know who he is, then let us explain that Raoul Pal is a prominent figure in the financial world, particularly known for his expertise in macroeconomics and cryptocurrency investments. Additionally, Raoul Pal is a former hedge fund manager and Goldman Sachs executive who has established himself as an influential voice in finance and cryptocurrency. His career highlights include co-founding Real Vision, a financial video streaming platform, in 2014 and predicting the 2008-2009 mortgage crisis. Furthermore, Raoul Pal's crypto predictions carry significant weight in the industry for several compelling reasons. Pal's generally bullish outlook on cryptocurrencies, especially Bitcoin and Ethereum, has the power to sway investor sentiment. His background in traditional finance provides a valuable institutional perspective, helping to bridge the gap between conventional investors and the crypto market. Pal's focus on long-term trends offers a broader view of the crypto industry's potential, while his market timing predictions, such as anticipating significant gains in the fourth quarter of election years, can influence trading strategies. Now that you know who he is and why his projections are important, let's listen to him again on what his analysis predicts about the future of financial markets.
Are at the relatively slow point of the economy where rate cuts are now kind of preordained, and the things that back it up are things like unemployment. I've been talking for a while that unemployment should rise. I don't think it's going to go super crazy, but now we're at the point where we're beyond the unemployment rate of the most negative Fed member. So obviously the signal is there to cut rates, and the Fed have made that clear. Maybe they come sooner, maybe they don't, maybe they inject liquidity in different ways. But either way, unemployment has been rising, and that is a key factor for the Fed, and inflation has been falling, which is the key factor for the Fed. So it's green lights all round to cut rates, and cut rates allows liquidity to come in to the system. So what happened is this mix of the DXY, which is the dollar, and the 10-year bond yields, and Fed rate cuts all came from the Fed starting to suddenly say, well, the market's starting to realize the Fed were going to change course, and then the Fed changing course by saying they were probably going to cut at the next meeting. And that set this whole thing off. Now, there's a lot of rate cuts priced in. They weren't priced in before, but I think they're more correct in how they're pricing things in. Will it work exactly how the markets are suggesting? I don't know, but I think rates come down to 2.5% or lower in this cycle. If you remember, the everything code needs low rates because you have to refi the $10 trillion of debt. So you need low rates to do that and liquidity to pay the interest payments on the prior cycle's debt, which is why the everything code is so important in this and why we keep repeating the same old cycle. It's because it's about paying the refinancing costs of the debt, and we're deep into the refi cycle. So I've been explaining for a while, the Fed and all the central banks need low rates. The Treasury needs liquidity within which to roll that and also to monetize the previous interest payments. That monetization of interest payments is what drives the liquidity cycle and the debasement cycle, which drives up assets. Also, as the business cycle bottoms, people have more money, businesses have more money, it gets reinvested, people invest more, and that builds on a cycle. Things like emerging markets do well when the dollar weakens. So therefore, profits get reinvested in the system, and the virtuous cycle of macro summer and macro fall play out. And that should play out all the way into the end of 2025. Okay, financial conditions are really important. So financial conditions lead the ISM, the business cycle, by 9 months. So we've been ripping higher in financial conditions for a while now, with some pauses en route. If you look at the current pause in the ISM, it matches the pause we had in financial conditions 9 months ago. But now it's been going higher. This financial conditions index doesn't take into account the fall in yields that happened this morning and the fall in the dollar. So by the end of the week, if those stick, we should see this even higher. But overall, as the dollar weakens and rates come down, financial conditions will continue to ease, and that will continue to lead the business cycle 9 months from now. What the financial conditions is really gives you a composite of all the countries with their leading indicators rising. So it leads somewhat, and it's telling you that economic recovery is on the cards. And that's what these OECD composite leading indicators are. They're showing you that global economy is recovering and financial conditions is what causes it to recover, which is important because that's where profits come from. That's where earnings come from in corporations. That's where household earnings comes from. That's where investment comes from. Money goes into the stock market. All of those things are driven by this business cycle. Okay, when we look at the global liquidity, you hear about me talk about global liquidity a lot. Well, you see, financial conditions lead it. The central banks pretty much act on the financial conditions. So there's a 5-month lead. So you can see financial conditions on this weekly basis have been chopping around a bit, but are moving higher. And that should mean global liquidity should follow. And financial conditions should be breaking out once the numbers are updated. And that will have the liquidity also rising. So liquidity is the prerequisite for markets to rise. And so that is all coming into the play. And now we've been given the reason. You know, people say, well, we need something to break. Well, guess what? We had it today. So we've got that. So global liquidity, when I look at it, global liquidity is about to break out too. I know you might think of this as a sin, doing technical analysis on the global liquidity index, but hey, it just shows the sideways contraction in global liquidity and the likelihood that it plays out, driven by the US, driven by Japan, driven by China, and also eventually driven by the Europeans and everybody else, because they all need to refi their debts. That's the big game, the everything code game. But now we've just added the percentage corrections in the boring zone to make it even more clear to you guys how this works. So boring zone 2012, 27%. Boring zone 2016, 38%. Boring zone 2020, 20%. Boring zone 2024, 27%. Right, so it's smack in exactly what you'd expect. And what comes next is the banana zone. And I don't want you guys to miss it because you're getting caught up in short-term time horizons of traders on Twitter. That's their time horizon. Nothing wrong with being a trader. I just don't think you'll make as much money. So I think you're better off to think of the long-term gain is how do I use these kind of opportunities to put as much money in as possible so I can capture the big upside when it comes. And I've shown you why that's not just a hunch based on these charts, it's actually based on the everything cycle. And that this macro spasm is actually the opportunity to really think about this, how you want to get involved.
Pal's analysis draws parallels between the current crypto market conditions and previous cycles, identifying what he calls the boring zone. This period is characterized by stagnant or sideways price action, which can test the patience of investors and lead many to exit the market out of frustration or disinterest. However, Pal's long-term vision for Bitcoin and the broader crypto market remains bullish, and he advises investors to maintain their positions and even increase their investments if possible. Pal's concept of the banana zone refers to the period when markets experience parabolic growth, often following these periods of relative inactivity. He believes that those who can withstand the current lull and maintain their investments will be well positioned to benefit from the explosive growth he anticipates in the future. This aligns with his broader perspective on the long-term potential of cryptocurrencies, particularly Bitcoin, which he has previously predicted could reach $250,000 or higher. And that's all for today. If you enjoyed this video, please give it a like, subscribe to our channel, and hit the notification bell so you don't miss any future updates. Thanks for watching, and stay tuned for more.